Welcome to Nichols' Weekly Tax Update Podcast. Wow, what a week. Just as we were preparing to record this program, we got breaking news. The second COVID-19 relief legislation passed both houses of Congress and headed for the president's desk. Amounts paid with PPP loan proceeds will be deductible or increased basis, even though the loan is not required to be repaid. Unheard of. My friends, the auditors, are going crazy trying to figure out how to make the accounting entries for this. Cash payments are on their way to millions of individual Americans. Foreclosures and evictions are under forbearance orders. Saying, watch this space. As soon as I can get my hands on a good copy of the significant portions of the act, which there's the Omnibus Budget Reconciliation Act or whatever it is, has this wrapped into it. As soon as I can get the language of the bill and read it and analyze it, I will have a special podcast in this space on that subject. So, as usual, welcome to the Nichols Tax Update Podcast. The program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert commentary. You're receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals, as I prepare this program and as I prepare this program every week. Without further ado, as they say, let's see what we've got. More questions on the 2020 Form 1040. It's never going to be simplified. Don't get your hopes up. The amount of a note receivable is income when the accrual method is otherwise required for a taxpayer. Then premiums paid for insurance to reimburse partners if promised tax benefits are denied is not deductible. Apparently we got a tax shelter promoter who's flogging a conservation easement contribution, and they bought insurance. You give them your money, and the tax deduction is guaranteed by insurance. If the IRS catches you and denies the deduction, then the insurance pays off. I'm not sure that such an arrangement is not against public policy, but we don't even get into that. Then the IRS updates frequently asked questions on the tax treatment and reporting of CARES Act higher education emergency financial aid to students. I wasn't even aware that the act included emergency financial aid to students, but there were emergency grants to colleges and universities, which they were required to use to provide financial aid to struggling students, graduate students and undergraduates as well. I didn't know about that. Did you? Then, as I said earlier, watch this space. 26 expiring tax credits tied to COVID-19 relief negotiations may be in, may be out. We'll know in a few days. Finally, watch out for taxable income from debt modification, which is a real possibility if it's not done correctly. All right, let's start. 38 lines and new questions on the Form 1040. That's up from less than 30 lines last year. More complexity and more information. For example, line 25 on the latest Form 1040 breaks down income reporting by Forms W-2, 1099, and any other information reporting forms that include income and or include withholding. Line 37, which notes that for filers of Schedule H and Schedule SE, self-employment tax, that line may not represent all of the taxes you owe for 2020. How foreboding is that? It refers you to Schedule 3, line 12E for details and instructions to figure out if maybe you owe more than just the income tax. And then new line 30, the recovery rebate credit, is for taxpayers to claim all or part of an economic impact payment tax credit that was not paid in 2020. Finally, there's this one, before you even get started, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire a financial interest in any virtual currency. The IRS is on the hunt for anyone who's dabbling around in virtual currency. Even if you didn't dabble, if you just dibbled, they want you. Amount of a note receivable. This is King Solar Man. They were in the business of installing solar towers. This decision goes all the way up to the Ninth Circuit, and I call your attention to the fact it's a 2015 fiscal year. So it's old law, but it's old law, but it's good law, right? A solar equipment manufacturer was required to use the accrual method of accounting and account for inventory because inventory was a significant income producing figure. They couldn't compute their income without calculating a change in inventory. Inventory was a significant income producing factor. So under the accrual method, the balance of a promissory note that they took as partial payment for the installation of some of their solar equipment is includable in gross receipts for the 2015 fiscal year. That's old law. When the cash method threshold was only $5 million, and King Solar Man's average annual gross receipts were just barely touching on that number, but their average annual gross receipts were under that number. So they thought that they were home free. Their average annual gross receipts didn't exceed $5 million, but still they had to account for inventories in order to do what? To clearly reflect income. The clear reflection of income doctrine trumps everything else. The note was received as part payment for installation of a standard version of the company's solar towers, so there was no special modification. There was nothing, no condition that would allow them to treat this note as anything but the proceeds of a sale. This one, yeah, you can't make this stuff up, right? Here's a tax shelter promoter, apparently has paid an insurance premium, has bought insurance against income tax increases for disallowance of a deduction in their tax shelter. This is an internal legal memorandum. The IRS wrote it in November. They released it in December. The bottom line here, after an analysis of the application of both Code Section 162 and Code Section 212 ad nauseum, is this. Federal income taxes are not a deductible expense. Therefore, premiums paid to reimburse a non-deductible expense are not deductible themselves. Now that makes sense to me, I suppose. Why would it not make sense to anybody? Who ever thought that would work? And the IRS has updated FAQs on college aid grants that I didn't even know were available. And by the way, FAQs change. The IRS updates them. Remember our rule? If we're going to take a tax return position based on an FAQ, we make a copy of the FAQs that are published as of that date, and we drop it in the client file. So if we're ever audited, we'll be able to produce the FAQs upon which we relied. Here, the IRS has updated a list of frequently asked questions on the tax treatment of emergency financial aid grants to students for expenses related to the disruption of campus operations due to the COVID-19 pandemic, including, now that's not just the disruption of the college's operations, that's disrupting the student's education, including eligible expenses under a student's cost of attendance, such as food, housing, course materials, technology, healthcare, and childcare. This is sections 3504 and 18004 of the CARES Act. The IRS will not require grants to be reported under section 6050S because the students are not required to report the income. So if expenses that are paid with grant funds can't be claimed in the calculation of any deduction or credit, by the way, so the student does not report income, and they don't get to treat those expenses as qualifying for any grant or credit. Check the COVID-19 relief legislation. That's a reminder for me on the extension of expiring tax credits. There are lower excise taxes proposed on craft brewers. There are credits for renewable energy sources. There's an extension of the preferential depreciation rules for motorsport facilities, and in a completely unrelated twist, out of nowhere, business meals may be 100% deductible when the smoke clears from this legislation. We'll see. I've got to look at it, right? Debt modification might create taxable income. This is again an article out of Tax Notes Today. I told you up front I rely on them for news of the day, news of the week. When the terms of this is something I've not really thought about. When the terms of a debt obligation are significantly modified, Section 1001 considers the old debt instrument as having been exchanged for a new debt instrument, and the old debt is treated as having been retired for an amount equal to the issue price of the new debt. That does not just apply to publicly traded debt. An extension of payment terms or a reduction in rate can change the present value of debt and result in Section 108 income from forgiveness of indebtedness. We need to be alert for that, and if your client has renegotiated debt, either dropped the interest rate or extended the term so that the present value of their debt obligation, considering all the interest to be earned and paid, is less than it was before the modification, you've got income from forgiveness of indebtedness. Now, if your client is insolvent, you qualify for a Section 108 exclusion. If your client is not insolvent when you start the negotiation, you may have taxable income from the transaction. Well, that's it for this week, gang. What a week, and what a week we're going to have as we all try to catch up with the latest news on the COVID-19 legislation. Stay tuned. We at SCAPA will be on our toes, developing information. There will be a special analysis of this of the act by our friend Bradley Burnett, who's developed his own expertise on this. So watch for news of that. Thanks, and stay safe. We need every one of you.